Hey everyone, I have a very exciting guest for you. I have someone that has been in the real estate game, in the podcast game, and in the education and helping business for quite a while. And we're going to talk to him about not only what he's doing today, what his story is, but most importantly, what are the greatest lessons he's learned from doing over 6,000 podcast episodes, and more specifically, over 1,500, approaching 1,600 for a show called Creating Wealth. So let's welcome Jason Hartman to the show. How you doing, sir?
Hey, good, Michael. It's great to be here.
Yeah, thank you for accepting this. Sometimes it's really weird when you get some guy you don't know reaching out saying, hey, let's talk. So I appreciate it. Why don't you just introduce my audience to who you are and what you do in this crazy world of real estate?
Sure. So I got my real estate license when I was 19 years old. I was in my first year of college. I wanted to be a real estate investor, but I remember learning from Earl Nightingale back in the day that, if you want to get rich doing something, first learn the business. So I thought I would just learn about real estate by getting my license and brokering. And brokerage took off as an actual career. I later purchased my own real estate company, then sold it to Coldwell Banker. And after that sale, I got back to my first love. That was a traditional real estate business.
Mm-hmm.
And my first love was really always helping investors. I
Mm-hmm.
really like the investor side of it, the analytical side, and so forth. And so that's what I've been doing for the last 16 years. I've been helping investors build nationwide real estate portfolios. It's been a lot of fun and very profitable as well. And about a year and a half, maybe 2 years into that part of my career, I started a podcast called The Creating Wealth Show. And now I have many podcast shows and almost 6,000 episodes, give or take. I haven't counted lately, but that's what we do. And I get to learn an awful lot by talking to people like you all day long, and
Right.
that's very beneficial.
Yeah. And that's one of the reasons I wanted to, that's why I've been trying to kind of chasing you down is, there's a lot of people out there that kind of, run the traditional route. They're investors and they do that for their main thing. Then there's people that are just out there, kind of the fake gurus that I call them, right? They
Yep.
did, they
A
did
lot
one
of a lot of
flip.
those fake gurus out there.
Yeah.
Yes.
They do one flip and suddenly they're teaching people how to do it. When I know you're
I know the guy who owns one rental property and now he's teaching people how to make millions in real estate suddenly,
yeah,
yeah.
not cool, not cool. Or they're down in LA or some expensive city and they're teaching you how to do it there and in other markets. It's just not okay. So I like the fact that you've been doing this a while. You have the traditional route. You've been in the business for decades. But I really want to talk about the Creating Wealth show because I think that's what most people come to real estate for, right? They're enamored by the wealth that it could create. So I'm curious, when you think about the nearly 1,600 shows, have there been any just big ahas or moments where you're like, that is something I'm going to remember for a long time?
That would be pretty hard for me to answer that question because I've interviewed so many brilliant people and done a lot of shows that are monologue shows where
Mm.
it's just me talking to the audience. So I don't know that I can think of like any sort of one or even
No.
three big ahas. There've been so many over the years. But I will tell you, I've definitely come to realize that income property is the most historically proven asset class in the entire world. And it's also the most tax favored asset class in
Mhm.
America. Taxes are the single largest expense any of us have. So we've got to learn to save on taxes no matter
Mm.
what we do. And it's just a great opportunity, and especially right now with this mass migration out of urban markets to
Yeah.
suburban markets. And we were maybe just lucky, we were positioned so well for that. We didn't really change what we were doing at all because that's what we've been doing the last 16 years is helping people invest in these low cost suburban markets where the properties make really good sense as rentals. And Michael, you alluded to it, but you didn't really explain it. Your audience probably understands what you meant, but
Sure.
just for those who don't, you talked about those fake gurus teaching people how to do rental properties or flipping or whatever in Los Angeles. And I grew up in LA, and that's an expensive market. It's a market that's in distress. Not a good place to invest at all. You
Hmm.
could never make the numbers work in a market like that. It's highly risky. And now people are leaving LA, they're leaving California, And
Hmm.
that trend's been going on for decades, but it's been accelerated by the current pandemic. And also the civil unrest with the
Hmm.
the race war and all of this kind of stuff going on. It's just crazy and sad.
Yeah. Yeah. I think again, like you, it's funny because I've been doing this almost 20 years. And in 2019, I was telling people that, you know what, Fresno, which is the only market I invest in, it is a California market, but it's Central Valley. It's where you
But
can
it's
live on 60 grand.
inexpensive.
Yeah. You can
So
live
at
on
least,
60
yeah, at
grand.
least Fresno, it can make sense. Yeah, yeah,
Yeah. So it's
yeah.
it's not LA and it's not the Bay Area.
Yeah.
But I
Tell
was telling,
tell me about your Fresno stuff for a minute. Like, what's your average price deal there, and that you do, and how much does it rent for? I'm curious.
yeah. So I mean, if you're gonna say that in 2020, the numbers aren't going to make sense because again, the tilt, right? So the deals I was doing in 2019, you could think of it as like a 120 to 140K turnkey house, probably 1250 rent. I bet.
That's not bad at all. That's a single family home.
Yep, 3 bedroom, 2 bath. Maybe you can stretch a 4, but probably a 3. Probably a carport or street parking because these are probably 1950s builds, 1960s builds. But yeah, they're solid rentals. And but again, I've been doing this a long time, right? I my most active year was 2010, and we were picking up stuff like that because of the crash for under 50 grand, same rents. So
And oh, so 150. It was more expensive then.
no, 50 grand, under
Oh,
50.
50 grand. Okay, got it. Got it. Yeah, that's great. And are those in really bad areas? I mean, there's a lot of
No,
gang activity in Fresno
no,
and
yeah, there's
some
something
pretty
called the
bad
West
areas, right?
Side, which is
Mhm.
93706. None of these properties are there. And, Fresno is not, there was certainly gang activity when I started in the early 2000s. It's on the West Side. It's a place you wouldn't go to. But no, there are plenty of blue collar areas. There's even, what I call the Cupertino, which is a Bay Area reference for those watching this, of Fresno, right? Where
That's
the
where
good,
Apple's located. Yeah.
exactly, where all the good schools are. So no, Fresno's grown up. It's not what some people think it is anymore. And again, it's one of the few California markets that makes sense for buy and hold investors. So, but where I was going with
Yeah,
that is
I agree.
2000.
And
Go ahead.
and we've looked at a lot of those California markets. I mean, I spent most of my life in California. We've
Hmm.
looked at Bakersfield, we've
Hmm.
looked at the Inland Empire in Southern California,
For
Riverside,
sure.
San Bernardino, and interestingly, at the beginning of my real estate career, I used to sell HUD and VA repos to investors in those markets,
Yeah.
but they were a lot cheaper back then.
Yeah. Yeah. No. That. Yeah.
Yeah.
It definitely California. California is an interesting market. If anyone reads my book, one of the things they're going to see is it's a very volatile market, which can be good or bad. But if you can dance through the raindrops, it could be highly profitable. So we got
Mhm.
out of
Yeah.
houses in '07 into apartments, and then in 19 we got out of apartments back into houses. And
Hmm.
kind of good timing, right? People were paying crazy cap rates because there was this guy named Grant Cardone saying bigger is better, and you
Right.
know
Yeah.
I've owned apartments in a recession, and I can tell you that it's not the easiest thing to own in a recession. So that's why we got out. We sold about 50 units in late 19, but now we're trying to buy as many houses as we can because we see the tilt, right? We see leaving urban areas. We see tech, which I live in tech capital of the world, telling their employees go home, and oh by the way,
Hmm.
go home
Yeah.
until next summer or go home forever. And now people are
Yeah.
going, shoot, do I want to rent a 4,200 square foot shoebox in San Francisco, or do I want a
Right.
3,000 square foot house somewhere else for 2 grand a month, right? And become owners. So
I
yeah.
You're gonna love this. Okay, so I don't know if you saw this article. I just read it this morning,
Uh huh.
and it is a Zillow forecast that says remote working could create. I'm reading it right here. Zillow, nearly 2 million renters can become homeowners thanks to telecommuting,
Exactly.
and people have discovered that the emperor has no clothes.
Yeah.
We used to have for my companies big, gorgeous Class A offices
Yeah.
in Orange County, California,
Oh,
and we used to spend 20 grand a month for office rent. And
yeah.
when you have an office, it's not just the rent. There's a whole slew of other expenses. You got, you got $70,000 worth of furniture and cubicles,
Yeah.
and just a million other expenses. So 20, 25 grand a month we'd be spending on office space. We gave up our last office in Irvine, California in 2012 when the lease
Yeah.
expired, because everybody wanted to work at home then. And I thought to myself, why am I fighting this trend trying to get my staff to come to the office?
Yeah.
Let them work at home. I'm going to save money. That's what they want. It's
Yeah. It's a
fine with me.
$250,000 a year. I mean, hell yeah. Let them work from home.
Big deal, definitely, or 300,000 a year.
Yeah. No. Yeah.
And
20. Yeah. That's true.
so this is the thing, you know. One of the things I've said on the Creating Wealth show many times over the years. I started saying this, by the way, back in 2012.
Okay.
And you know, let's not misunderstand this statement, but I'll say it, right? Geography is less meaningful than it's ever been in human history. Geography is less meaningful than it's ever been in human history. Now, you know, the three primary value drivers for real estate since the beginning of time, Michael, since we were living in caves, has been what? You know what I'm going to say? Location, right?
Exactly,
All three. Yeah. And now that location has really been disrupted because, you know, and the funny thing is, this technology is not new. You know, we had WebEx 20 years ago.
Yeah.
We had Skype, 15, 17 years ago, I think.
Something
Skype came around.
Yeah.
You know, it's not like this is, Zoom is newer, of course, but, you know, it's not like this technology is that new, right?
Yeah.
It's just that now everybody, even my mother who hates technology, is using Zoom.
Yep.
And they figured it out because they were forced to. And
I agree.
You know, employers have figured it out, and workers have figured it out, and you know, companies are going to save a ton of money on office leases.
For sure.
Would not want to be investing in office properties right now. And let's go back to your point about apartments, because I think that was interesting too. Now, just to give you my apartment history, I do own one small apartment now with a client of mine, and I used to own with another client two big apartment complexes. One was 139 units.
Ooh, wow.
We sold that last year. Another one was 125 units, and we sold that a few years ago.
Okay.
And we also have a mobile home park together that we still own. But I like single family homes the best.
Mm-hmm.
And one of the reasons I like them the best is that, you know, when you're running an apartment, you got to realize you're running a business.
Yes.
That's a business. It's going to have, you know, one example, like every business, it's going to have a Yelp page. And tenants are going to go there and complain about your building or your apartment complex and your bad management. And they're going to get together and start talking to each other, and they're going to do rent strikes like they are now. You know, and the funny thing is, we read all these articles, and many of our investors have expressed concern about these rent strikes that are going on around the country. But that's like a non-issue in the world of single family homes. At least with our clients and my own portfolio, everybody's paying the rent. Like, I haven't heard of anybody trying to take advantage of the COVID thing. Just normal, you know, you're going to have a few non-payers here and there always, right?
Yeah.
Nothing different with COVID. But if you have apartment complexes, there are significant rent strikes going on. A lot of institutional landlords are experiencing that. These tenants get together and they form a mutiny. They gang up on you, you know? So it's a different thing. I'm not saying you can't make money. Of course you can. You've made money. I've made money with apartments, but you know, it's just, you got to understand there's a difference between a business and an investment.
Yeah.
Okay. And that's a business. You can own a bunch of single family homes. That's an investment. It's low management responsibility.
Yeah, there's so much. This is so much fun talking to somebody in the business. So a couple of things. First, back to the employer one. You read the Zillow article about 2 million folks. Again, that's an investable trend. I've been telling folks we are going to see an uptick of home ownership. Right today, roughly it's about 66, 67%. It could approach 70%, which would be on par with what we saw in 2006. But it will be healthy ownership. The 2006 peak of 71%. About 4% of that were renters becoming owners that should have stayed renters, right?
And it was janitors and school teachers making, you know, 50, 60 grand a year buying $900,000 houses.
Adding a zero to their thing. It's funny.
The banks have been very conservative, obviously, this time around, and they've probably been too conservative, but that bodes well for the economy, or at least the real estate economy.
Residential real estate. Yeah, exactly.
Right.
And again, I think home ownership's good, right? I think home ownership, I mean, again, I can only talk about my personal experience. I would not be where I am today if my mother and father didn't get a GI Bill to buy a house. you know, back in Sunnyvale, California, right? Because they never had any money, right? So that was the thing that we lived on when my dad was unemployed, and we went through these cycles in the 70s and 80s and 90s. So I believe homeownership is good, and I'm really glad that there'll be 2 million more homeowners than renters over the next couple of years. That's awesome. But also companies are saving money. $11,000 per
companies,
employee. That's what I read yesterday.
That's the office space load
Yeah.
for, right. $11,000 per year per employee, right?
Exactly.
Yeah.
Yeah. That's
And
real money.
get this, in the post-COVID world, that cost is going to skyrocket. Now, granted, the office lease itself could get a little cheaper,
but
the packing density per employee has got to get way lower. You know, there's, you know, you can pack maybe 1 employee to 200 square feet per person of office space. But now with social distancing, you know, that is
total
out the
layouts.
window. Why, you know, huge layouts, building walls to separate offices, really expensive HVAC units, ducting, filters, wide hallways, all sorts of problems. And everybody listening should understand this, Michael. This is not just about COVID.
No.
It's about paranoia. It's about post-traumatic stress disorder. Even after there's a vaccine, there's going to be another thing. There's going to be a new SARS. There's going to be a new swine flu. Everybody's going to be paranoid. This is like a generational shift, if you ask me. This is not going back to normal anytime soon.
I'm glad you brought up that generational world, because I've been talking for a long time that, you know, I'm 50, right? So I've been waiting for the crisis that changes consumer behavior. It wasn't the dot-com crash. It wasn't 9/11. It wasn't the financial crisis. As horrible as all of those were, and they were all horrible individually, they didn't change consumer behavior. What we are in now, this 2020 year, is going to change consumer behavior for at least a decade, and perhaps multiple decades. And that's going to be, perhaps we save more. Perhaps the whole notion of an emergency fund becomes real. Savings is up. People are saving more, right? We still have
I have a chart I could share with you that it would blow your mind about the personal savings rate. When the lockdowns were really in full swing, I mean, it's like a hockey stick.
Yeah.
The personal savings rate just skyrocketed.
Yeah.
And yes, you know, when you have an economy based 70% of the S&P based on consumption, you know, that's not good in the short term. But overall, listen, if you want to have a wealthy society, you've got to have capital formation. People have got to save some money, so that they can invest and buy a house and whatever. So
and then get through crisis without going to zero, right? That's
right.
This is all good things. It's felt in the short term, hence a Q2 drop in GDP of 30+%. A lot of that was savings, right? Because when you save, it doesn't go to GDP. So it's very important stuff. Then let's go back to apartments and my love of houses. Again, I've been doing this a long time. I will invest whatever the best deal is. Today, I believe it's clearly housing. We have the tilt, which we've already talked about, which is when you compound that with lack of supply, means prices go up, right? If you're already an owner of stuff in the suburbs, it's going to be good.
Explain the tilt. What does that mean?
Yeah, I think what we're seeing with the U.S. tilt is, again, picking on New York and San Francisco. You can throw L.A. in as you want. There's a mass exodus from these high density, unaffordable.
Well, you can throw Seattle in there. You can throw a whole bunch of places in there.
Chicago,
Portland, of course, is a disaster. I mean,
and it's all going. The tilt is going south, right? Warmer, Arizona, Nevada, Texas. But I even call it a greater tilt. We're talking Georgia, Florida, that kind of that panhandle down there. That's the tilt that I see.
Business friendly, right to work states.
Yep.
Yeah.
Exactly. Yeah. So that
low taxes.
With low or no taxes. Yeah. Or at least state taxes.
And good weather. Yeah. Hey, listen, I live in Florida now. I have 0 state income tax. It's awesome.
Good for you. But again, I think that's becoming investable as well. I think, just look at what's happened between New York and Miami, right? Manhattan real estate, just read this morning, 15,000 vacant homes in Manhattan just came out this morning.
Yeah.
But you're seeing $1 million homes fly off the shelf in Miami. That is, people with financial means are leaving. And oh, by the way, don't forget taxes, right? You'd already talked about Florida being 0. California and New York are both looking to raise taxes on the wealthy, and which is idiotic because the wealthy have the most financial means, the most flexibility. They will leave. And then what will happen? people don't see it coming. The middle class is going to have to pick up the bill, and
Yep.
taxes are going to go up on.
And the middle class has been leaving for decades now, and this is just accelerating the trend that was already happening. And if you look at the tax proposal from Biden, it
Mhm.
is absolutely insane.
Mhm.
If you combine that, and I just did a podcast on this on Tuesday,
Mhm.
I think it was Tuesday's episode where I did a huge rant on this, and I did some math on it. If they get their way in terms of federal tax rates, and you combine that with living in a place like the Socialist Republic of New York or California, or any other high tax environments, you could literally be paying 68% of your income
Yep.
in income tax. You'll be working for the government for almost 8 months of the year. 8 months of the year goes to the government almost, and then not only that, if they do a federal and or a state wealth tax,
Yep.
which means, just understand how insidious that idea is. It's so scary, because if someone got wealthy, they've paid tax all along the way. They've already paid tax, right,
Mhm.
many times over.
Yep.
But after that, okay, then you take the business they have, the real estate they have, the savings account, the brokerage account they have, and you say, okay, pay us a percentage of that every year.
Yeah.
Well, what if they say, the business isn't liquid?
Yep.
Well, sorry, you're going to have to sell the business, lay everybody off,
Yeah.
or whatever. Maybe it's an inopportune time to sell it. Maybe the market's not good. Maybe the
Yeah.
timing's not right. Sell the business to pay the tax.
It's
That
crazy.
is insane. That would be so destructive.
That's so
And
funny. I did.
it's happening at the state level.
Yeah.
In terms of California, for sure, they've
Yeah.
got it on
Well,
the
San
table. They want to
Francisco at the
eliminate Prop
city level.
13.
Yeah.
This is
It's just,
nuts.
it's idiotic.
These
It's
people
funny
are out
that
of
we
their
we
mind.
see the world the same
Yeah.
way. I tried to simplify
Yeah.
it. I did a show, and my wife's Asian, so we have mangoes at home. So I did a show about a mango tree, and I said, think about this as a mango tree, right? Your mango produces 100 mangoes a year, but because it
I
produces
love
more than
mangoes.
50,
I just
you
had one
have
the other day.
yeah, because it produces more than 50, you owe me 10% of that mango tree every year. So it produces 100. Now you have to give 10 away. You whack the branch. Now you get 90 the next year. You whack the branch.
Yep.
Now you have 81.
Yeah.
Pretty soon you're down to a stub and you have no more mangoes. That's what this stupid wealth tax is.
Yep. Welcome to socialism and communism. It's never worked anywhere in the world or at any time in history.
Yeah. Well, let's see if we can't turn this around and make it more positive. Because again, I see tremendous investing opportunities coming. I think we do have pain through the rest of 2020. It just, we are in it. It's muck. It's mire. It's ugh. But I see coming out of
Well,
this
I don't know if we
2021.
have pain. I mean,
Oh,
I
really?
mean, I'm not. Do we have pain? I mean, it's certainly there are many people suffering, but there
Yes.
are many other people doing great. I mean, it's very uneven
Oh yeah,
what's
it's
going
the
on.
K-shaped recovery I've been talking about, right? If you're on
Yeah,
the winning side of the K, right, up,
right.
right, you're in the
You're up.
assets.
Yeah,
Yeah,
you're
you're
down.
whew. But the largest percentage of folks, probably always been that way, are on the other side of the K and down. I do
Yeah.
think.
Some of these people, though, wait,
Mhm,
hang on, Michael.
sure.
One thing I want to point out, though, some of the people who are seemingly on the downside of the K,
Mm,
who are unemployed, who are in, maybe the restaurant service industry or whatever, where they can't work or they
mhm,
can't, their businesses aren't making very much money,
mhm.
right? They are using this downtime to improve themselves. They're learning how to code. They're starting a home-based business. They're doing all kinds of stuff, and
Yeah.
they're saving money. So, some people are going to rise out of the ashes of this,
Well,
and it's going to be really, overall, they're going to move into a better life and have more wealth to stimulate the economy with.
yeah.
So it's, again,
That's yeah.
those who are using this time as an opportunity will be okay.
Yeah, totally agree. And I came from the lower side of the K, so it is certainly possible. It's what makes America great,
Yep.
and all of those things.
Me too.
And that's why I call
I was
2021 going to be the year of the entrepreneur. Because not only do I
there.
see people on the bottom side of the K using this opportunity, saving money, and then moving up, but I also see restaurants and retail and all these people that, yes, there will be bankruptcies. Yes, there will be closures. But the people that will step in behind them, They will get remarkably low lease rates. They'll be able to charge less for food or have higher gross margins, whatever they choose. And they'll be set up for a year of gangbuster, or decades if you sign a long enough lease, going forward. So I see 2021 and going forward being really good. I personally think we have more pain just because of the negativity out there that we're all going to, a lot of people will buckle down as we get closer to the election, because who knows what happens there. But I think we come out of this in January, guns a-blazing. We're going to have low interest rates for seemingly a decade. I think it gets really good next year.
That's interesting because we had an event recently, our annual Meet the Masters of Income Property conference, and it was our first time doing it virtually. And one of our speakers was Ken McElroy, and he's predicting, he's the Rich Dad author, if anybody knows, and he's a good friend of mine. And, he's predicting a pretty gloomy time coming up. But again, I think
he's pretty apartment heavy.
Yeah, of course he is. He's totally, that's 100%. And I think the move will be away from apartments because of density, of course. People don't want to live in high density environments. But, I just don't think anyone can make statements like that because it's so uneven. It just depends. It depends. And, like Wayne Gretzky said, skate to where the puck is going. And we know, your listeners know, my listeners know, my YouTube watchers know where the puck is going. And, so.
Yeah. Again, Ken McElroy is a great guy. If you guys don't have his book, I think it's ABCs of Real Estate Investing, written 20 years ago. I have one of the first copies, or one of the first runs. So like the guy, and I love what he's doing on his YouTube channel. But again, he is apartment heavy. I think hospitality is in the most pain, right? There's a lot of resetting in hotels, probably going to condoize some of those. Retail is next, office is next, and then there's apartments. Who's the winner? I think it's what we talked about earlier, single family homes. We have 2 million more owners coming. We have, first off, there are going to be losers. San Francisco is going to lose, right? Home values are going to go down. New York, Manhattan, home values are going to go down. But when you talk national numbers, you're going to probably see, 8, 9, 10% nationally, because, and again, I think builders were caught off guard. Right? There's a lot of development in San Francisco and New York that now they're discounting, right? Some discounts are 50% because, now people are leaving and we're not building in the suburbs. So I think there's a lot of construction coming, and real estate's 10% of GDP. It could be 12, 14% for a couple of years. I think single family homes are the winner out of this, I think.
I think you are absolutely right. I think you nailed it. And when you say builders were caught off guard, you talked about the builders in these high density cities that people are leaving, but builders in the suburbs, business is booming. Right. I mean, they are just raking it in right now. Lumber costs have skyrocketed.
Yeah, 80 some odd percent.
Adding about $14,000 to the price of any new home, the average new home. And it's just the supply shortages continue. And it's absolutely crazy. We just don't have enough inventory for our investors. We need more housing inventory. That's the key thing.
Yeah. So one of the things I'd love to talk to you about is the great, I don't know if it's a great hope. I actually think people are making more out of this than there is, but it'd be interesting to see where you are, is all of this forbearance, right? There's some inventory that would be on the market today that isn't because it's in forbearance. You can argue how much that is, because there are some people who lost their job that can't pay the mortgage that, in normal times, that would be a sell. If they have equity, it would be a sell. If they don't, then it would be a foreclosure and all of that stuff. But unlike last time, the banks are helping people, right? I invested last time and the banks said they won't help unless you're 90 days late in 06, 07. Now they're like, shoot, you can have a 90-day forbearance for a click on a web page, right? Totally different.
They've got their act together this time. They know what to do. They learned their lessons 12 years ago. Don't wait. Offer the assistance right away, and then you can call those loans performing because you've done a plan. You've got a plan, right? And the government acted quickly, and so did the Federal Reserve. I mean, it's
crazy.
Jerome Powell's a pretty interesting Federal Reserve chair. He's the complete opposite of Alan Greenspan, who talked in code. He's just like, whatever you need, we're going to give it to you. And that's great for real estate investors.
There's no reading between the line. There's no Greenspan, or there's no code. I think that's very well said. He's very clear. and concise. But again, I think, do you see enough inventory sort of stuck in forbearance that would actually marginally impact, supply? Or do you think most of it gets worked out or stuck on as
Well,
seconds or what?
are you saying that that's inventory that would end up going to foreclosure
Well, I
if
don't
it's in
necessarily see.
forbearance
I
now?
don't think it'll be
Or
necessarily foreclosures, but it might be a sale, right? Because you could have
uh
20% equity but no job, and
yeah,
you want to get that
yeah,
30 grand out, right? That's still a sell. It's not a foreclosure. But I'm thinking
right,
there's
yeah.
some inventory. Let's just call it 2 million homes that are in forbearance between the government backed and private banking. And what, I don't know what the number is, might be 4 million, but let's say it's 2 million. I think more than half of that stuff gets worked out because they can go for a year, and most people can get a job within a year. And then they'll just stick on the payments as a second, as I've heard, which again is, they didn't do that 12 years ago. So I think a lot of that gets worked out, but I do think there's some inventory that will come on the market when forbearance periods end. And I think it's arguable how much.
Well, so that's really shadow inventory you're
Correct.
asking about.
Mm-hmm.
First of all, we don't know if forbearance will end,
That's fair.
because there's always another bailout coming. This is a
That's
very interventionist government.
fair.
Fed and Fannie Freddie are very much
Mm-hmm.
interventionist,
Mm.
which, you could argue that that's good, because they're not sitting on their sitting there doing nothing,
Yeah.
right?
Yep.
I think we can almost really just hang our hat on as there's always going to be another program.
Okay.
The government does not
That's a
sit by
fair.
anymore. That's just
Okay.
not the world we live in. Okay. So, people are saying, well, what happens when this ends? What happens when the bailouts of whatever type and fashion end? Well, what makes you think they're going to end?
That's a
It's
good point.
politically popular
Yeah.
to give goodies to people. Okay. I mean, everyone from, Hugo Chavez to Obama to Bush to, the current administration, Trump, whatever, the next administration. I mean, no administration, unless, Ron Paul is going to run for president again, would ever say, we're not going to do anything and we're going to be like libertarians and get out of the way and let the market take its medicine. That's just not
Okay.
the world we live in anymore. So that's
Good
the
point.
first thing. I don't think
Okay.
anything's ending. Okay. I mean, it might end for a matter of a few months, but then there'll just be another thing.
Okay.
Okay. Yeah.
That's fair.
And I think we really can bank on that. I
Okay.
think we absolutely can.
Awesome.
So that's one part of it. But that inventory could be absorbed so quickly.
Yeah.
I mean,
That's where I was going.
and keep in mind,
Yeah.
even if forbearance ends, say it did end, right? But that's not going to get people to move. They're just not going to pay. So they're going to sit there as long as they can for free. And last time around, we saw foreclosures in the judicial foreclosure states take a year, 2 years, 3 years.
3 years. Yeah.
There are people even in non-judicial states like California that are still sitting in their homes and haven't made a payment in many more years than that. I know
there are
of
some.
one.
Yeah.
And so they're going to milk that as long as they possibly can.
Yeah.
So again, that makes the time frames uneven.
Correct.
Which is actually good for the market, because no
absorption
inventory dump
is easier.
ever occurs.
Yep.
Absorption is slow and measured. Well, not measured, but it's
you get time.
Spread out.
Yeah.
And there is so much demand to absorb anything in the suburbs or even rural areas, as long as it's not a high-rise condo in a city.
Yeah.
Okay.
Exactly.
You're fine. I mean, the market has a lot of legs.
I think the K-shaped recovery we talked about earlier about investors moving up, I think it's same for the real estate markets. I think like just pick on New York and San Francisco and then insert any other city you want. There are going to be compounding things that go bad. I mean, for example, if you ask for forbearance in a condo in San Francisco that was worth $5 million and now the building's half full, you're going to let that thing go just like last time. I mean, strategic default was a freaking verb, back in 2006 and 7. And urban cities are going to have them, but the market, the country, absorption, demand is so high that it'll just absorb it. And you're right, it's uneven, right? It never comes on all at one time, right? I was buying a lot in 2009 and 10, and every Monday you would just see a big dump, and in the MLS. It's just not going to be that way. They learned their lessons from last time, I think.
Yeah.
Yeah.
Yep. Absolutely.
Yeah.
Absolutely.
So as we wrap this up, I want to make sure we kind of broach this subject again. Nearly 1,600 episodes of creating wealth. And I'll just ask it plainly this way. Do you think it's still possible for someone starting today to create wealth with real estate?
Well, the first way I'd answer that question is, I mean, what is your other option? What's the alternative? On my show, I always ask what my listeners have dubbed the Jason Hartman question. I didn't make that up. They said that. Okay.
Okay.
And the Jason Hartman question is, compared to what? That's always the question to ask. So what else are you going to do? You can invest in the stock market. You're going to think you're going to create wealth with your day job. Not likely.
Right.
You know, what are you going to buy? Gold? I mean, Bitcoin. You know, all these things are very speculative. Yeah, they could do well, but then they'll do badly. Then they'll do well again, and you know, it's a roller coaster.
I agree.
So the sure thing is income property. It's the most historically proven asset class in the entire world. It's the most tax favored asset class in America. It's the most debt-friendly asset class in America, and that debt can make you rich. You know, I explain that in detail on my show and my YouTube channel, Inflation-Induced Debt Destruction concept. So, yeah, I think it's a fantastic investment class.
Very cool, Jason. Well, do us a favor. How can my audience follow you? You do so many things. Where do you want them to go? You do so much for us.
Yeah, on any podcast platform, just type my name, Jason Hartman. That's Hartman, Jason Hartman, and you'll find the Creating Wealth Show and many other podcast shows that I do. YouTube, same thing. I've got a growing YouTube channel and a lot of good information there. And then my website is just jasonhartman.com. So happy investing to everybody and to you, Michael, and thanks for having me.
You got it, buddy. Take care of yourself. Bye.